How people double and even triple and quadruple their retirement income by doing a strategic 401k or IRA rollout, not a rollover, okay? A rollover is going from the frying pan into the fire, okay? That's taking money in 401ks, rolling it over to IRAs, and continuing to postpone, defer, procrastinate till age 72 or 73, and then taking RMDs, required minimum distributions, thinking you're saving tax. No, you are compounding and increasing the tax liability, stretching it out. This episode will show you how to do a strategic rollout, and I'll give you examples of how we have saved people $250,000, $750,000, $1.2 million of unnecessary tax. We do this all the time. So I'm Doug Andrew. I've been a financial strategist and retirement planning specialist now for 5 decades, helping thousands of Americans optimize their assets, minimize taxes, prepare for a comfortable retirement where they will not outlive their money due to the negative impact of taxes, inflation, and market volatility. So we make them immune from those 3 dangers, and we oftentimes increase their net spendable income by double, triple, even quadruple. So many people, they sort of have their head in the sand, so to speak, and it's open season with the IRS. And so at retirement, they had this rude awakening, and they have been duped. And I'm talking about 91% of Americans, I think, have been duped, being told to put money in tax-deferred IRAs and 401ks and defer to some future perceived unknown advantage. You'll likely be in a lower tax bracket when you retire. Well, most savers are not in lower tax brackets when they retire because they were going down the highway, so to speak, trying to achieve this destination of financial independence, and they had one foot on the gas pedal and the other foot on the brake pedal. The foot on the gas pedal is putting money in these tax-deferred accounts, IRAs and 401ks, but the foot on the brake is they're usually killing their tax deductions, okay? They pay off their real estate or their house. They don't have those deductions if they pay them up. If they were a business owner and they sold their business, they don't have those deductions anymore. You're not contributing money to IRAs and 401ks in retirement, so you don't have those deductions anymore. If you were a business owner and you sold your business, you don't have those deductions anymore. And most people agree that because of irresponsible government spending, the printing of money, taxes will likely be higher in the future. The kids are gone, or if they move back in as adult children, you can't deduct them anymore. So people are in higher tax brackets. So when I ask most people in seminars, how many of you think the taxes in the future will likely be lower? I get nothing but crickets. How many think they're going to be the same? 1 or 2 hands goes up out of 1,000, but how many think they're going to be higher and a sea of hands goes up? And I go, why are you continuing to defer? And this is where they just get this deer in the headlight look, okay? Because so many times retirees look at their IRAs or 401ks like it's this sumptuous Subway hoagie sandwich depicted here on the left. And then I show them, no, that $1 million is not all your money. Only about 700,000 of that is your money. If you think that $1 million can generate 75,000 a year of income, only 50,000 of the 75,000 is your money. The other 25,000 belongs to the government, okay? And so it looks like this unappetizing sandwich on the right after the government has taken their share out of there. Well, this is why many people that came to me at retirement, because at retirement planning is something totally different than what you did for retirement, putting money in IRA to 401ks, I would tell people to bring their after-tax IRA 401k statements to the first appointment. I knew they didn't have those, but I wanted them to, think about it. And so I would calculate that for them, and they were flabbergasted that about a third of what they thought they had was not really their money. And so I would ask them, golly, are you planning your retirement or Uncle Sam's? Okay, it's the best savings bond the government ever came up with for themselves. So I had to establish stable datum. These 2 things are certain. Money will never be worth more than it is today, and your current tax bracket will likely be the lowest bracket you will ever be in. Do you agree? Inflation, okay? And because of all these reasons, your current tax bracket will likely be the lowest. So let's get the taxes over and done with sooner than later while your account values are lower and tax rates are lower. So that requires what is called a strategic rollout, not a rollover. A rollover, again, is taking money in your IRAs or 401ks, but particularly people get duped putting money from their 401ks and rolling it over into IRAs, deferring till age 72 or 73, and then taking RMDs. That's not saving tax. I can prove that to you. So strategic rollout. So I'm going to go through an example. I want you to follow me here, and then if you need to read this again, I'll show you where you can get a copy of my book and study this example and several others. I have another example I call Tax to the Max versus Mrs. I've a Lot More. Mrs. I've a Lot More has twice as much income, just like the Smiths do versus the Jones. So listen very closely as I go through this, okay? Because you may get lost if you don't understand where I'm coming from. These two couples are basically on the same page. They have the same assets. I'm going to keep this simple. They have $500,000, let's say, accumulated in their IRAs and 401ks at age 59 and a half. They can now tap into that money without a 10% penalty. But the Jones get duped. They go to their advisor and they say, well, we're not retiring yet. We are going to sell our home and buy two retirement homes, one in a summer climate and one in a winter climate, okay? And so they both have homes worth $1 million, okay? And so the Jones have $500,000 in IRAs or 401ks, and let's say they're earning 7.2%. I like that number because rule of 72, the money's going to double in 10 years, easy math. But also 7.23% is the worst return indexed universal life achieved during the worst 10-year period since the Great Depression. I'm talking about 2000 to 2010. You would have earned 7.23% even without rebalancing. If you don't know what rebalancing is, most of our clients earned 11.17 during the Great Recession, not 7.23. But 7.23, your money doubles. So here is a traditional advisor telling the Jones, if you don't need the money, keep deferring. So that $500,000 at 7.2% is going to double to $1 million in 10 years. So far, so good. Now, let's say they retire at age 70 and they want to live off of the interest. Now, they don't have to start pulling money out until between 72 and 73 now with RMDs, but let's just keep it simple. 7.2% if they wanted to withdraw the interest only, and that exceeded the RMD, so that they're not penalized, that would be $72,000 a year of income. But that's all taxable, okay? Most people are in a 33% combined federal and state income tax bracket because this is not their only resource in retirement, okay? They have even Social Security or school teacher's pension or what have you. So in a 33% bracket, they're going to pay a third of that in tax and net $48,000 or four grand a month to buy gas, groceries, prescriptions, and golf green fees, okay? Now, the Jones have a $1 million house and they work their whole life to pay it off. And so they're going to sell that and buy two $500,000 homes, one that they're going to live in during the winter time. It has a warmer climate, and then one in the summertime in a cooler climate. Many people do that in retirement, and they downsize, but they buy two homes, two retirement homes. They think, well, we're going to sell our house for $1 million and then pay cash for two $500,000 homes. We didn't pay off our house to have a mortgage payment in retirement. I get it, okay. Well, the Smiths, they came to our seminars, they read our books. Let me show you the difference. Their $500,000 in IRAs or 401ks, they're not going to sit there and postpone and procrastinate. They're going to get that money out and the taxes over and done with. They're selling their $1 million house, but they read my book and they go, you know, when you sell your personal residence and you buy a new one or buy new ones, that's the wonderful opportunity to reestablish what is called acquisition indebtedness in Internal Revenue Code Section 163, meaning you can tax deduct the interest on your primary residence and a secondary residence if you finance it, mortgage it within 90 days of acquiring it. If you don't, you cannot deduct the interest on your personal tax return, okay? A lot of people don't know that. Now, why would you do that? Smiths understand how money works. They know that borrowing on those homes, they can earn a rate of return that's going to be double the net cost of the mortgages, and they will resurrect tax deductions that they killed by paying off that house. So what they're going to do, they're going to sell their house, and they're only going to take 20%, 200,000 of that million, and pay $100,000 down payment for a $500,000 home, and another $100,000 down payment for a second retirement home. So they're using 20% for down payment, which is required usually by most lenders, but they still have $800,000 of equity. And we put that into their IUA laser fund, okay? Now, if that is only earning 7.2%, and by the way, my IUA laser funds have earned between 11 to 14. This is so conservative, but I'm going to keep this just very conservative. Now, what we're going to do is they have an interest payment due on these two mortgages on these two retirement homes. At 7.2% interest, they're going to have $72,000 of interest. But it's actually their friend, not their foe. So how are they going to make that interest payment? Well, they withdraw $72,000 a year out of their $500,000 IRAs portfolio. And when they withdraw that $72,000 withdrawal is going to show up on the front page of their 1040 tax return. It's subject to tax. That's what we want. We want to get the taxes over and done with. But it's 100% offset because on another page of their tax return, they're using it to pay the mortgage interest on their mortgages. That's a wash. They realized $72,000 of income, but they didn't have to pay tax on it because it was washed away with tax-deductible interest, which they can do, okay? In 10 years, people go, what? $72,000 a year out of a $500,000 IRA or 401k earning 7.2%. If you do the math, it's now depleted it. You just depleted your IRAs or 401ks paying interest. That sounds so stupid. Really? We got that money out tax-free. What was the trade-off? That $800,000, okay, the homes are now worth $2 million. The $800,000 of equity doubled to $1.6 million, okay? You times that by 7.2%. I keep mine mortgaged 100% loan to value. That would be $144,000 a year, okay? Now, could they take $800,000 out of this money and pay off the mortgages? Yeah. If they have just $1.6 million in their IUA laser funds, they can take half the money out and pay off their mortgages. But why would they do that? Most savvy people go, why would we fire an employee that's making us twice as much as they're costing us? So if they're like me, I keep the mortgages. Most wealthy people keep mortgages on their house until the day they die. Why? Because the net mortgage payment isn't 72. In a 33% bracket, it's $48,000. They have 144. They have 96,000. How much more is 96 than 48? Double. We do this all the time. The point I'm making here is because the Smiths understand how money works, they're in more control. They have liquidity. They have safety. Their money's not tied up in their properties. If we have a real estate crash, they will lose, the Jones. If the Smiths do, they won't lose. They can just peel off half of the money and make their mortgage payment, okay? They still have actually $96,000 of profit, double what the Jones do. And the Jones are perplexed. They thought the Smiths were dumb. No, the Smiths were smart. They got their money out tax-free, and they end up having twice as much money as the Jones do, and they were on the same playing field just 10 years earlier. Now, if you didn't understand this, watch this again. And then also I'm going to show you how you can read the story in my book and also the story of Tax to the Max versus Mrs. I Have a Lot More. Same kind of an example here. So there are other stories in my book. We save school teachers $250,000 of unnecessary tax on their 403Bs and 401Ks and TSAs. We saved a real estate landlord $750,000, and we quadrupled his income. He was only going to net $16,000 a year taking RMDs out of his 600,000 IRA 401k portfolio following his advisor. In 5 years, we got the money out with no tax. He had some rental properties we mortgaged. He was earning 3 times more than the cost of those, but we got his money out tax-free, and now he has $75,000 a year of tax-free income instead of $16,000 in net after-tax income. We quadrupled his income. We had husband and wife physicians that had $4.6 million accumulated in IRAs or 401ks. I couldn't save them all that in tax. But their advisor, when I calculated, you're going to pay $2.6 million of tax if you take RMDs. And their advisor said, well, they can afford $2.6 million. They have $4.6. I go, well, let's ask them if they want to do that. I said, if I could save you $1.2 million, would you be interested? They said, absolutely. We saved them that much in tax, which is generating $100,000 a year of cash flow tax-free for the rest of their lives. Folks, we do this all the time. We took a California couple that had $6 million in their IRAs or 401ks. We did a strategic rollout. They bit the bullet, paid $2 million in tax over 5 years. They netted $4 million in IUL laser funds. That $4 million in 7.5 years doubled to $8 million. They now have $8 million tax-free, generating $600,000 to $800,000 a year of tax-free income. We do this all the time. We had a couple come to us with $2.6 million in IRAs or 401ks. At a 6% payout, they said, we think we could have $160,000 a year of income the rest of our life out of this. We have another $40,000 of Social Security or school teacher pension. You know, they're thumping themselves on the chest. We have $200,000 of income. I said, well, I see one big problem. It's all showing up on the front page of your 1040 tax return. They said, there's another way. And I go, yeah, you're going to pay at least $54,000 or more in tax the rest of your life. That's if tax rates don't go up, and they knew they would. You're only netting $146,000 to buy gas and groceries. We did a strategic rollout in 5 years. We got $120,000 of that $200,000 off of their 1040 tax return. The IRS knows they're receiving that. They know everything, but it's tax-free. They have the same $200,000 of income. Actually, we increased it to $240,000. But apples to apples, they have $200,000. They now only pay tax of $21,600. They net $178,000. If taxes never increase, they'll save $32,400 a year in tax the rest of their life. $800,000 out to their life expectancy. We do this all the time. So folks, whether you're a single tax filer, you have room in your lower brackets. If you're married, you have room. For example, 2024, a married couple filing a joint tax return in the 22% federal bracket, between $94,300 and $201,000, there's $106,000 of room. If your taxable income is somewhere between those numbers, you have room that you will lose if you don't use it by getting the money rolled out of those IRAs or 401ks and paying 22%, which is likely the lowest bracket you'll ever be in. Between $201,000 and $383,000, there is $182,000 of room. If you have $80,000 or $100,000 of room you're not using, I would recommend you use it before you lose it, or you're going to be kicking yourself. I don't care if you need the money or not. Get the taxes over and done with at 24%. If you don't, they're going to go up to 28. 28% isn't just 4% more. It's 16.66% more money. If you have to pay $28 on every $100 instead of 24, that's 16.66% more money you will pay in tax. So explore a strategic rollout, okay? I recommend, if you like to read and learn, claim a copy of my book. It sells on Amazon, The Laser Fund, How to Diversify and Create the Foundation for a Tax-Free Retirement. You can get it on Amazon for $20 up to $60. If you purchase it there, thank you. But I'll gift you a copy free. You simply click on the link below or go to laserfund.com and you contribute a nominal amount toward the shipping and handling. I'll cover the rest of that, and I'll pay for the book. I'll fire out a hard copy to you via priority mail. But if you like to listen and learn or watch and learn, there's those formats also. But it's actually 2 books in one. If you're a left brain learner, the white side has 14 chapters with charts and graphs and explanations. If you're a right brain learner, you learn more by stories. You flip it over to this one. This one is 12 chapters, about 100 pages with 62 actual client stories. And you'll learn these stories that I've been talking about by reading the right brain side. If you want to use your whole brain, read both of these, okay? But when you're in there claiming your free copy, if you want to schedule a no cost, no obligation appointment with an IUL specialist that I've trained and oversee, they'll show you how these strategies may apply in your particular set of circumstances and how you can perform a strategic rollout and get the taxes over and done with sooner than later, and then take that net and put it into something that's going to be tax-free the rest of your life. And when you ultimately die, anything you leave behind blossoms, reimburses the tax that you likely paid. Sound too good to be true? We do it all the time.